Hello, and thank you for joining our Q3 Manufacturing Outlook webinar today. I'm Richard Austin, BDO's National Head of Manufacturing. For our webinar today, we're delighted to be joined by Make UK's Chief Economist, Seamus Nevin, and Senior Economist, Fhaheen Khan. Seamus and Fhaheen will be providing an update on the state of the UK manufacturing and sharing the findings from our Make UK and BDO Manufacturing Outlook report, which was published this week. We are also joined by BDO Digital Risk Advisory Services partners, Fiona Davis and Tim Foster. With the rising ESG agenda across the manufacturing sector, Fiona and Tim will be sharing ESG insights from our report, covering why ESG should be a priority for manufacturers and sharing practical actions that should be taken to reassess your position and address ESG going forwards. The presentations will then be followed by a live Q&A. So please submit any questions you have through the Q&A functionality at the bottom of your screen, and we'll pick these up at the end. Today's webinar is being recorded, and we will follow up with a link of the recording and our Q3 report. With that, I will hand over to Seamus and Make UK. Seamus.
Good afternoon, everybody, and thanks for joining. I'm going to give you a brief overview of the political and current affairs landscape as it is at the moment before I hand on to my colleague Fhaheen, who will update you on the economic performance of the manufacturing sector. I suppose the big news of recent weeks was when the Prime Minister announced an increase to national insurance contributions. The manufacturing industry fully supports the need to increase funding for the NHS and social care, which is obviously one of the most important issues we face as a society, particularly as we start to recover from the COVID-19 pandemic. However, economic history tells us that job cuts are most likely when an economy starts to reopen again after a downturn, because firms need the capital to reinvest. After witnessing large-scale redundancies at the height of the pandemic and the plug now being pulled on the furlough scheme, putting a tax on jobs and workers at a time when the government is pulling the furlough scheme is therefore seen by many companies as ill-timed. And we will need to nurture the green shoots of recovery that we are witnessing in this quarter's manufacturing outlook results. So extra costs on businesses are a concern. Related to this is the fact that hundreds of thousands of British households and businesses face a very difficult winter thanks to rising energy costs. This has been all over the news for the last few days, but energy bills are due to rise in October, although the price cap restricts further increases over the winter. The spike in global prices, which has already triggered a collapse of several British suppliers and threatened many more, means that there is a risk of further rise in the next review point, which is in the spring. 5 small suppliers have gone under in recent weeks, and another 4 are likely to collapse before the end of the month, according to current headlines. But the number of collapses is expected to escalate as cold weather compounds record energy price highs. A joint statement from Kwasi Kwarteng, the business secretary, and the energy regulator Ofcom last night stressed that the crisis was not an issue of supply and said there is absolutely no question of the lights going out, but many factories report starting to discuss reductions in their operating capacity, such as 3- and 4-day working week, or reducing their hours because of gas prices and the consequent shortage of CO2, particularly in the drinks sector, which is a growing concern. So for many listeners, this may sound like a throwback to the 1970s. Companies are already struggling with a backlog of haulage and HGV capacity and growing labour shortages linked to both Brexit and COVID, as well as the global supply chain disruption due to the pandemic. Some manufacturers are now delaying and cancelling planned work because they are not confident that they can hire the workforce that they need. So firms will continue to call on the Home Office to relax worker visa entry rules, and that is something that Make UK will continue to work on behalf of manufacturers up and down the country. Boris Johnson has also announced a delay to the planned introduction of new post-Brexit import checks, which will be good news for many firms concerned, though others say they will need to pass on extra costs of delaying this implementation to consumers. As it is, the manufacturing industry is paying a premium for energy compared to our European competitors anyway, at a time when also firms are facing other costs to do with cutting carbon emissions. So we will have to look out for a lot in the autumn statement, which is due to be delivered by the Chancellor on October 27th, alongside the spending review. The review takes place roughly every 3 years, and it will be the first one since the UK left the European Union. In a statement, Chancellor Rishi Sunak, who kept his job during the recent reshuffle, outlined that total resources available for the next 3 years include a 440 billion increase to day-to-day spending by 2024-25 and an increase in capital investment rising to 600 billion over 5 years. Total core government spending will rise 4% in real terms, which will have to be funded. Lots of commentators are predicting changes to inheritance tax and capital gains tax following recent announcements, but that could also push up inflation as well. That being said, we shouldn't forget that some tax rises can be done in a much more discreet way. As we know, corporation tax is already set to rise substantially by 2023, and various forms of pandemic support, from furlough to business rates relief, are being phased out. So it doesn't seem likely that the Chancellor would risk many more business tax increases. But as I said, that doesn't mean that the government can't increase a tax take from business in other ways, particularly if inflation continues to rise relative to other business costs. In terms of incentives to help business grow, the review into improving the UK's research and development tax reliefs, which is due to publish shortly, may result in an announcement of enhanced R&D reliefs. The Chancellor has promised to publish the final findings of the government's business rates review soon also. It is probably rather hopeful to assume that radical reforms will be announced in the budget, but the government is trying to improve the way tax works for business and is likely to announce a consultation on technical changes sometime this autumn as well. So worth keeping an eye out for that if you have an interest in submitting a response based on what it is likely how it is likely to affect your firms. With COP26, the UN Climate Change Summit taking place in Glasgow next month, the government will also want to show that they are playing their part in the effort to make the UK economy carbon neutral. Thankfully, this is something most manufacturing companies are keen to support, and the shift to the green economy alongside the Levelling Up white paper due out sometime in the autumn as well is something that promises to revolutionise British industry in the coming years. So it's a mixed bag on the political front. There lie many challenges ahead, but thankfully, as you will hear shortly from my colleague Fhaheen, the economic picture this quarter is quite positive overall. So there's lots of room for optimism as well. And with that, I will hand you over to the next speaker. Thank you for listening.
Thank you very much, Seamus, and welcome back as well, I must say. So welcome to our third quarter research, where we bring you an update on the state of manufacturing. As you will have known, particularly over the last couple of quarters, we are aware that the recovery was already well underway since the start of 2021, since the UK had reopened. So what have we seen this quarter? Next slide, please. So according to our latest survey, output and order levels have continued to expand at record rates, reaching a new high, of the highest on our survey record since 1998. Most of this growth has been dominated by the domestic market from our perspective in terms of orders, but equally so, we are finding that exports are recovering too. However, the main challenges that have been highlighted by manufacturers across the UK are around rising cost pressures, and we are seeing that filter into record increases in prices as well. However, on the other side of that, we are also seeing that manufacturers are seeing their profit margins improve, which is some good news, given that margins have been negative for quite a long time, according to our survey. Employment has continued to grow despite labor shortages actually stunting that growth somewhat this quarter, but it is expected that manufacturers are still keen to hire, but there are vacancies that are, although currently unfilled, there's great intentions to increase the manufacturing labor force. And in reverse side of that, investment intentions have also actually increased to the highest level ever. So this is the intentions to invest in capital and machinery over the next 12 months. So all in all, we are expecting a pretty strong Q4 as manufacturers expect further growth towards the end of the year, topping off a very, very strong 2021. And as a result, we have slightly adjusted our manufacturing GVA forecast, although it's still quite in line with what we had last quarter. We expect manufacturing output to grow by about 7%, just over 7% in 2021, keeping pace relatively close with UK GDP, which we expect to grow about 7.26% for 2021. Next slide, please. So let's take a bit of a deep dive into the specific data itself and have a look at some of that historical figures as well. As you all know quite well by now, the manufacturing industry faced a pretty challenging year in 2020 as businesses shut down, supply chains were breaking down, and orders declined to their worst rate ever. As you can see on that kind of minus 56% balance of change for output, and I believe it was about minus 54% for orders. Those were the two lowest figures we had ever recorded on our survey. However, since then, since the start of the year specifically, we have started to see the industry take a very positive turn as the pandemic-induced boom in demand led to a burst in output, increasing to meet that demand from all the new work. In fact, in our latest survey, you can see that order books, and if you look at the very far right end, we can see the orange bar just tipping the red bar quite significantly. That's indicating that order books are expanding much faster than the output levels as manufacturers. The only problem that they currently face is struggling to meet that supply or meet that demand with their supply. This is a result of various issues from shortages in very critical components, much of which you would have seen in the media, significant delays in lead times to getting those components, even when you find that supply. So why don't we have a little bit of a look on that orders picture, a little bit in more detail, as you may be wondering, where is this demand coming from? Next slide, please. Well, we split the orders indicator on our survey between domestic and export orders. So these are orders coming from UK firms and orders coming from international ones. As you can see, the picture looks very similar to what we had seen in the previous slide, where during the pandemic, orders from everywhere essentially declined in Q2 last year, and there were severe declines in Q3 of last year. But since the start of this year, we have seen some growth returning. However, since that recovery started, what we've been really seeing is that the domestic market has essentially been dominating that growth in orders. This is partly down to trading itself being more difficult than it was 9 months ago today. But exports seem to be recovering too, and that is positive. And we put that down to the positive effect of the pandemic boom being slightly greater than the negative impact of UK-EU trading being slightly more challenging today. But at the same time, the exports and the negative growth in exports, or the slow growth in exports, is slightly masked by the fact that because of supply chain disruptions, whether or not there is a free trade agreement between the UK and any other country, it is very difficult to actually source components from abroad. And as a result, what we have been seeing is UK manufacturers have actually been showing a greater interest in things like reshoring. To what extent that has already taken place is difficult to actually test. But what it means is that manufacturers today are more willing to seek new suppliers domestically, and that is partly driving the increase in the domestic order books, but also those firms who are specialized in supplying to UK firms only are taking that opportunity to actually position themselves as an alternative to the EU. But of course, that's not necessarily possible when it comes to every single input. And I think whether or not we see an increase in reshoring over the next few years will really depend on how long you expect these supply chain disruption challenges to persist. So if manufacturers are making their business plans with an expectation that this is the new normal and we're going to have long lead times, high prices for the foreseeable future, they are likely to see a greater interest in reshoring, where those that expect these issues to diminish within the next year or so, they may not actually consider taking that investment step by onshoring their foreign production to the domestic shores. Next slide, please. We can look at this data from a subsector perspective. This isn't all the industries that we cover within our survey, but it includes some of those that we consider to be the suppliers of intermediate goods. As you can see in a few of those, rubber and plastics, electrical equipment, basic metals, in these particular industries, you can see orders are vastly exceeding the output growth, which indicates that manufacturers here are actually struggling to meet demand for the goods or the components that they provide. This is very reflective of some of the issues I've already mentioned with supply chain shortages, such as what you would have seen like semiconductors, but also things just like simple things like plastics or cardboard boxes or various types of precious metals. And as you'll see shortly, these issues are currently filtering down into higher prices, and it is affecting businesses further down the supply chain as well. Next slide, please. Thank you. So one of the questions we ask to get a sense of where foreign demand is originating from is to really where are manufacturers seeing a notable pickup in demand by categories of different markets. As usual, every quarter we tend to see the EU still being the top market for most manufacturers and where they see the biggest increase in demand from overseas. The North America often is the second best market, but what we found this quarter is that the Middle East has just slightly edged past Asia. Normally what we have is Asia is the third best market, but this time we have seen manufacturers indicating that they're seeing slightly better pickup in the Middle East. This is partly down to a lot of these supply chain issues, what I mentioned with the plastics and the semiconductors. A lot of that stuff is actually from the East Asian markets. And because of that, it's been the demand conditions have actually picked up a little bit slower over there and a little bit faster in the Middle East. From our point of view, this is probably just a blip in the data, and it's likely expected that we're going to go back to a little bit of a normal situation by the end of this year, with Asia coming back into third as the supply chain situation is expected to at least improve somewhat by the end of the year, but we'll have to wait and see for that. Next slide, please. Thank you. This is the last slide where essentially we focus on output and orders before we move on to prices, investment, employment, and margins. Every quarter when we run this survey, there's actually two parts to every question that we ask UK manufacturers across the nation. The first one is, of course, what you have seen, which is the current state of output and orders and the other indicators that we measure. The second one is where we ask members to actually make a forecast of what they think will happen in that quarter. If you do that long enough, then you can start plotting these predictions against what actually took place in that time. So what you're seeing here is that the red and orange bars are the forecasts that manufacturers had made for that quarter, and the dots are actually what took place in that quarter. Historically, manufacturers are generally quite good at predicting the trend in growth in their output and orders. But as you can see here, so from the Q2 2020, manufacturers actually predicted growth that quarter, but then the pandemic hit and there was a huge decline in output and orders. Manufacturers actually predicted a return to growth in Q3 2020, but they were wrong about that. Over time, they actually became quite pessimistic. And what we saw from the start of the year, at least from since 2021 Q1, is that manufacturers were quite often underestimating their growth. So if you look at the 2021 Q1, manufacturers actually expected a contraction in the industry, but they achieved some growth. Then they predicted a growth in Q2, and they actually got growth to be twice as fast than they predicted. And in the latest survey results, manufacturers actually got almost very close to what they predicted would take place, which is quite interesting, although they did underestimate the growth in orders. For now, what we expect is that manufacturers are predicting further growth in output and orders, and they're expecting output to expand faster than orders. But we will have to wait and see whether or not they're right about that. But what we can infer from this chart is that the level of uncertainty which has been plaguing the manufacturing industry for many, many years now, it seems to be diminishing to some extent, that now they are able to at least plan ahead a little bit better than before, and that is a good thing in itself. Next slide, please. So now for perhaps one of the most interesting slides, which have become more interesting over the last couple of quarters because of what's happening with supply chain and labor shortages. Many of you will have actually seen the inflation data being published by the ONS, indicating rises in prices for consumer goods. But so far, I think overall concerns on CPI are relatively low. But what gets a lot less attention in the media is often the inflation taking place upstream, which affects manufacturers more directly. So these include stuff like the cost of inputs, but also other overheads like labor and wages. Since the start of the year, manufacturers quarter on quarter have reported domestic prices and export prices increasing, with domestic prices growing faster than international prices. And that is down to that demand in the domestic market being greater than the exports, resulting in a faster price increase for UK goods. We have been collecting a lot of anecdotes from our members over the past few months, and several reasons have been cited. Many of these have already been mentioned in this presentation, and a lot of them will not surprise you, but it includes a list of a growing list of issues from shortages of raw materials, increasing lead times and freight costs, and more recently a growing concern over labor shortages, which results in wage inflation, which are resulting in the fastest rate of price rises we have ever seen. For the time being, we don't have an indication of when these issues will diminish, but for now, it seems that manufacturers, if you look at the far right end with the green box, which is a forecast of prices, manufacturers expect both UK prices and export prices to continue rising till the end of the year. But on the flip side to that, manufacturers are also responding or reporting that their margins are growing alongside price. So this is quite positive, particularly as margins have been showing negative balances since before the pandemic. And now it's good to see that manufacturers are actually benefiting, perhaps for the first time since the issues that they have faced across, since I guess the double whammy of the pandemic, but also the change in the trading relationship with their closest market. Next slide, please. Thank you. Confidence has been on the up since lockdown ended, and manufacturers' optimism is currently at its highest ever we've recorded. So despite the challenges highlighted on the previous slide, it seems that manufacturers are moving forward with their plans anyway. Because of these confidence figures, we are also quite optimistic about the industry's future. However, it's worth keeping in mind that an indicator like this one, something like confidence, can be quite volatile. It can change day to day. For example, this metric was actually recorded before the announcement of the increase in national insurance contributions. To what extent this would have affected the future confidence of businesses is unknown. But for the time being, the pandemic boom has been quite positive, and manufacturers are almost overwhelmed with the level of orders that they're receiving. And that is, from their own words, a sign of good problems. Next slide, please. So here's a quick focus on employment and investment. Employment grew for the second quarter in a row this year as manufacturers needed people to support the outstanding level of work they have been receiving. However, last quarter, so if you look at the final red bar, but just before the one with the green outline, manufacturers actually predicted the growth in employment to be twice as high as it actually was. This is down to issues like labor shortages and the increasing cost of high-skilled workers, which have made it very difficult for manufacturers to fill in job vacancies. And for the time being, at least for Q4 2021, manufacturers expect to drastically expand the manufacturing workforce. At least this is what you can see as an intention. So this is the red bar with the green box aligned, which is a forecast for next quarter. Manufacturers intend to do a lot of hiring by the end of this year. Whether they are able to do that in reality will just depend on how easy it is to actually find workers, because the current situation is that it has been quite difficult to do that. But more positively, and perhaps this is one of the best stories of our latest survey, is that investment intentions. So these are the intentions to invest in capital and machinery over the next 12 months are the highest that we've ever seen on our survey, meaning that manufacturers are finally turning their attention to much needed investment in productivity, enhancing capital to meet that new demand. How much of that demand is driven by government schemes like super deduction? It's difficult to separate this because manufacturers, their investment strategies are often very, I guess you have to plan ahead 5-10 years at a time sometimes, and they're very strategic investments depending on what they expect will take place over the future of their investment plans. So if your orders are exceeding your output capacity and there is a need to expand that capacity, then it stands to reason that manufacturers will make that investment into expanding that capacity, and that is what they are doing. The likely impact of super deduction is that it has made that decision to make those risky investments a little bit easier. But whether those manufacturers would have made that investment anyway, it's likely the case in many situations. But it will be difficult to actually separate that situation when we look back on these figures 5 years from now and we look at the impact of such a scheme on manufacturing investment. Next slide, please. And just to finish up, these are the overview of our forecasts. We expect manufacturing GVA, gross value added, to keep pace with GDP by growing about 7% this year. So despite these supply issues that I mentioned, manufacturers are extremely positive, and the growth in demand is expected to result in manufacturing output growing quite significantly. We expect a little bit of a slowdown in 2022, as we expect that kind of pandemic-induced boom to sort of subside over time, given that pent-up demand can't obviously persist for a long time. And our expectations at the moment, very positively, is that we do think that the industry is going to recover to its pre-pandemic size by 2022, mid-2022. How long it will take for it to actually achieve the lost growth where it would have achieved if there was no pandemic is difficult to say, but we do expect at least it will reset to its 2019 level by then. Thank you very much. That is the end of the presentation. The next slide is just a quick overview of the initial results that I mentioned earlier on. So as a summary, output volumes and orders have reached a new record, which is mainly being driven by the domestic market, although exports are recovering. The main challenges are around prices and supply chain issues, but margins seem to be improving for manufacturers. And although employment growth has slowed, we are expecting a significant growth in employment as well as investment over the coming year, which leads to a very strong 2021 when we get our results for Q4, which we expect, and therefore we have very strong forecasts for this year. Thank you very much. I will pass on to the next person.
Thank you, Fhaheen. If I may start with an introduction on my side, we have myself and Tim Foster, who you'll hopefully see in a second. Thank you, Tim. Maybe just a quick intro our side. Well, why are we here today to speak to you about ESG? Well, from a personal perspective, I've very much been living and breathing this agenda over the last 10 or so years, very much starting off with the regulatory landscape, then moving on to helping organizations really build out their frameworks to enable them to report on increasingly diverse metrics, and eventually be able to provide independent assurance, which has grown in demand. But more recently, I've equally been providing reporting to investors on ESG as part of listing processes. So the ask, the demands around the ESG have very much continued to increase over that period of time, and I have been privileged to be part of that. So that is a snapshot of myself. But Tim, would you like to introduce yourself?
Yes, thanks, Fiona. I'm Tim Foster. I'm a DRAS partner in BDO. I too have been spending quite a lot of time talking with my clients around ESG. I spend quite a lot of time with clients talking around governance, risk management and control. So ESG is very high on their agenda. Helping them to navigate and understand what the requirements actually are and some of the good practices that we're seeing across companies and sectors and how they can actually adapt those and adopt those within their organizations. It's certainly very high on their corporate agenda as well.
Thank you, Tim. So Tim and I would like to take a slightly different approach today, because between us we have quite a lot of insight in terms of what's happening in the manufacturing space, but that obviously coupled with what is happening across ESG and the evolving demands makes for some good debate and some good insights within it. So there will be quite a lot of discussion as we weave in some of those analogies throughout our key points. So firstly, thank you very much to the team for allowing us to explore this area today, very much to the forefront of most board agendas. And I think it's very difficult for us all not to be aware, at least, of what ESG is at this stage. We already heard from Seamus before in terms of what is happening in the news, where we cannot but turn on our television and hear something else on that agenda, be it Boris Johnson's latest update on pushing in terms of doing more in climate change, ongoing supply chain issues, ongoing resource challenges, very much ongoing points of debate. But today we have a very mixed audience, I understand, in terms of where you all are on your own respective ESG agendas. Some of you have already taken some definitive action, as we've seen through from the surveys, and others of you who perhaps a bit in denial in terms of needing to do anything. So we hope to be able to address some of those points today. So just looking here at the agenda of what we want to be able to go through. Firstly, what does the ESG agenda actually mean from a conceptual perspective, really shining a light on some of those drivers and the demands that are bringing that to the fore. Then what does this actually mean to you in terms of specifics in the manufacturing sector? You know, what is the breadth and depth of those ESG risks you should be worried about? Then moving on very much to the why. What are the benefits of actually doing this? Why should you be taking action now? And then finally, some practical hints and tips in terms of what you can be doing now if you haven't done so already. I would say that we will also try to pepper in some of the findings from the ESG survey, which came out of the last quarter as well, which has been very insightful in terms of where you all are in terms of your differing levels of maturity. So just moving on to the next slide then. So ESG concepts. Why I wanted to bring this up is that we're all getting very confused with the lingo which is out there. It seems to be a continuous change in terms of the name of what this agenda is. So most will be familiar with the sustainability or the CSR type agenda. And this has very much been the umbrella term which has been used in terms of the efforts that have been undertaken from businesses, ultimately really to create that positive vibe in what we're doing in terms of creating more balance and detracting from some of the more negative impacts of our actions. But this has been very qualitative in nature. It's been very hard in terms of creating comparability or understanding between businesses. So what we have now is the shift to the ESG agenda that we now know and love, with very much that focus on the three key pillars of environmental, social, and governance. What is great about this as well is it is much more metric based, much more evidence driven. And as we'll explore more, the need for the specificity, the measurability, and very much data driven within it, ultimately allowing for greater visibility and greater ability to benchmark, as I previously mentioned. So just moving on to the next slide then. So let's look a little bit at the evolution of sustainability practices. I mentioned on the left in terms of where we were with the CSR agenda. Very much the purpose of organizations at that stage was all about profitability, but then we've seen that gradual move up in terms of the more qualitative and quantitative on the ESG side. But thinking about what have been the real drivers for that. Tim, when we discussed this, you outlined that one of the questions that you're often asked by clients is, who are you actually trying to satisfy with any potential ESG efforts? So how would you typically respond to this, and how would that conversation ensue?
I think it's a good point. You know, when you're looking at ESG, I think it's quite easy for us to jump straight into the fact that this is being driven by, you know, lending bodies, investor groups, regulators, etc. And we tend to forget some of our sort of value chain stakeholders as well. Say, for example, you know, board members are finding this, you know, really important for them because obviously, you know, the stewardship, the responsibility that they have for the organization and making sure that they are you know, a environmentally friendly, socially aware organization. They're making the right decisions with around those sort of agenda points. I think your other group, which sort of stands out more and more, is your customers. You know, they're becoming a lot more focused on, you know, how sustainable, how environmentally friendly, how socially valued you are as an organization, particularly when they're making their purchasing decisions. And on the flip side of that really is suppliers. We're seeing suppliers obviously trying to make themselves more attractive and using ESG to some degree as a competitive advantage for their products and services. I think the one that we tend to forget probably most is actually our own people, you know, and our own employees, you know, and actually we're seeing quite a big shift, not only us as a firm, but also across our client base, with a lot more of a social awareness, a lot more drive from employees to work for environmentally sustainable organizations. We're seeing it more and more with, particularly, graduates and new entries into the employment landscape are much more socially aware and want to work for organizations that have high values, have social awareness, that they're doing sort of social activities, that they are thinking around, environmental issues, climate change, etc. And to some degree are actually picking organizations that have more of an ESG sort of set of values than say, for example, higher salaries.
And Tim, do you think that COVID has been a key factor in influencing what their voice is and what they're actually looking for?
I think we sort of saw this. It goes back to what you were saying before, Fiona, about ESG is not it's not a new concept. It's been going on for quite some time. So I think that there's always been an awareness around the various facets of ESG. I think the remote working, COVID environment, and also a number of other sort of challenges which have come up in the last sort of 18 months has made staff more aware. I think, the fact that they can work from home, they don't have to travel as much, that they can, work much more sustainably in their own homes, except all those sorts of things. I think it is making it, I think it's sort of challenging convention. So it's sort of starting to open up those thought processes about, actually, I don't need to carry on working for the same organization day in, day out. I can actually make choices and work for organizations which have better values.
I think that employee aspect is very important just to think about for a second. As Fhaheen mentioned before, with the challenges on the sector in terms of attracting, well, the resource shortage which there is, and therefore being able to attract the people that you need and want within your organization, that is a critical factor in terms of how you set out your stall and what you do on that social side of things. I know from our own BDO perspective, as we have shone a light on how we have attracted people, one of the key factors they have outlined is our cultural report and how we're very clear and transparent on what we do across our people agenda. Of attracting individuals, so that has been pretty critical. But if we even look at some of the stats, that millennials are now the major demographic, representing over 34% of today's workforce, and they set out very clearly that they see the purpose, clearly defined purpose of an organization being laid out in terms of doing the right thing as a really critical factor in their decision process. All the more important in terms of employees as key drivers of us taking the right decisions and really being on top of what we're doing in this agenda. Tim, just thinking about the evolving side on the investor and stakeholder influence as well. What have you seen in terms of demands from the investor community in terms of that coercing people to take more action or be much more transparent?
I think mainly the investors are well, they're becoming, well, certainly from a funding perspective, we're seeing a lot more where, if organizations are looking for additional funding, you're getting more investor groups with very high ESG agendas, and they are pushing it. You're getting, pension trusts, for example, or pension investment groups, are putting pressure onto, asset managers and what have you to invest their funds in more sort of green funding or greener organizations, more environmentally friendly, more socially aware. But again, I think, as we've spoken about before, Fiona, we've seen that historically as well. I mean, we drew out an example, I think from 1960 or something, where one of the teachers' pension schemes, would only allow their funds to be used to fund social housing, for example, But I think there's just a greater awareness across the investor sort of portfolio, private equity. banks, etc., about making sure that they're investing in the right areas, and just thinking more deeply, I think, around the ESG agenda. Is it a socially aware organization? Is it environmentally friendly? But also just, thinking more broader than that, and then not just sort of putting money just directly into organizations which have a huge return. There's a lot more value driven sort of decision making process, I think.
Absolutely. I think a useful stat to reinforce the importance of this is that there's currently around $30 trillion, which is basically a third of the world's managed assets, which are flowing through ESG and impact investments today. So very much an area of focus in that investor community. We'll move on a little minute to some of the metrics and things that they are looking for, as well, as that tends to be quite a varied playing field. I think here it's also really useful to look at the regulatory angle of it, as I think the manufacturing sector in particular is no stranger to regulation across the board and across the different dimensions of ESG. This one in particular, I think for me, it feels like it's always been the biggest stick and the biggest factor in terms of the actions that need to be taken. I've mentioned before about the regulation I've been involved in over the last 10 years, and we've really seen this grow in momentum, ranging from the GHG in the early 2010s, the greenhouse gas reporting requirements, but moving up into more of those social elements, be it Modern Slavery Act, prompt payment code practices, gender diversity, obviously a real focus on those and growing in momentum. And then more recently, we've had the streamlined energy carbon reporting requirements, and indeed the TCFD, the Task Force for Climate Related Financial Disclosures, which is really coming to the fore in terms of bringing climate to the forefront of decisions. So regulation in a way is one we can't get away from, and is the de minimis position for many as the big stick which is out there. I mean, Tim, any perspectives on regulation for you in terms of how you've seen in the sector that they have responded to this, accepting, in denial, what the approach has been?
Well, I think most are accepting it. I think there's an element of, they're accepting it because it's something that they need to do. If I'm talking to a lot of clients, particularly in manufacturing, it's they typically come back and say, look, this is all something, particularly on the environmental side, this is stuff that we've had to deal with for quite some time. The social side is probably a bit newer for manufacturing, and I think there's always that element on the governance side. Good governance, it's always played in the background to varying degrees, depending on whether you're listed or whether you're small, medium, or large, etc. So I think that most of the change is really being around the sort of formalization of the ESG dimensions and what we need to do about it. How we report, when we report, how much detail we need to go into with our reporting. You mentioned around metrics and disclosures, but actually I'm starting to see clients sort of thinking in a bit more of a different way than those sort of key elements. They're revisiting their products and services, for example, and looking for new ways to make them more environmentally friendly. We're seeing, because again, I think some of this is down to, the resource constraints, investing more in training, investing more in education within for their staff, making sure that they have sort of social programs, making greater awareness, a more attractive place to work. Others are looking through, their processes and their policies, making sure that they align with their values and ESG objectives. And I think a really big one is because there's a high degree of this which is requires change and transformation within an organization. And I think there's a lot of time starting to be spent on training staff, because there needs to be that raising awareness about what ESG is. What does good governance look like? What should we be doing in terms of social agenda? You mentioned a few things around gender pay gap, equality and diversity through the organization. So there's a lot of those aspects that need to sort of be bedded down and sort of revisiting the culture, which, in some cases may have been sort of, either historically male or those sorts of environments, so that they can actually open up the sector and make it more attractive to a broader range of people.
Absolutely. I think that's it's a really good insight into starting to look at some of those business practices which are outlined within the slide along the bottom. And maybe just to add a little bit of color to that, folks, in terms of some of the results that we saw coming through against these in the recent survey as well. We talk here about specific practices which are now required to meet these drivers of change, to meet the demands of ESG. And 4 components being measurable, reportable, transparent, and holistic. What is quite interesting is that from the survey and the measurability side, it's really about being able to set clear metrics, KPIs, which are important and which are going to be measured off as a business. Only less than half of you, around 42%, have actually set any KPIs on this yet. So there's a lot of hesitancy. We're seeing that there's over half of you have set a strategy, but slightly less of you are actually creating tangibles within that in terms of targets that you're going to meet. Then thinking of the reporting component of that, only 36% of you currently publicly report on what those metrics are and how you've actually met them. There could be a result of some element of confusion in the market, as we know that there are many different standards out there, and there's concern about which one should I report against. So there's quite a lot of hesitancy out there, but it is quite interesting how low that number is. But the transparency comes into the public reporting component of it once again, and being able to really tell your story and shine a light upon it. But the final aspect is really around it being holistic. Many of us have been very focused in the past on very much that environmental side of it. I mentioned about the sustainability agenda at the beginning, and we've seen a lot of footnotes at the end of reports which have mentioned about some great initiatives that we've put in place as businesses. But actually, the holisticness we're referring to here is actually about really bringing to the forefront what you're doing across all strands, from environmental, social, and governance. It's not just to focus on one particular area. So quite a few specific components here needed to really bring this to life. But maybe just moving on to the next slide, Baljit. Thinking here of the breadth and depth of this agenda. As I mentioned, there's a lot of confusion about what should I report, but there's lots of guidance out there in terms of what you should be considering, and this really shines a light upon how broad and deep it actually is. But we all too often think about the challenges that this brings in terms of how we go to address this. But an interesting point, Tim, that you mentioned before was right in the heart of this as well. There's a real opportunity for innovation, how we respond to the risks and opportunities that are out there. And we see this here in the sector in terms of business innovation and model, how we're looking at redesign, how we're looking at reassessment of what we are doing. Do you have any good analogies of any of your clients, if you've seen really grasp this and sees the opportunity for innovation?
Yeah, I think we see quite a bit, really. I mean, some of them are more grandiose, sort of forms of innovation than others. You will have much more sort of sweeping projects with an ESG driver, things like, seeing some clients that maybe change their entire fleet of vehicles or what have you to electric. We will have, some where they are bringing in sort of operational changes, so maybe where they're bringing in new technology to reduce the use of water. We're seeing production facilities that are using sort of energy recapture technology, and putting that back in to either heat the plant or to capture the energy and then reuse that as part of the manufacturing process. We're seeing quite a few who have certainly ramped up their investment programs and brought those forwards. to look at sort of newer technologies, which maybe, they use lower levels of energy. They might require sort of, they might be siting, some of their facilities which are, closer to key customers, so that they're reducing, footprint by having to sort of ship materials and parts and etc. around. So there's a whole raft of things really, which, for me, it is innovative in terms of that it's thinking about ESG and thinking about doing things differently. But you're absolutely right. Some people are thinking, more innovatively around, how they design their products. But I think a lot of that comes back to what I was saying before about, what our customers actually want. They will want, products which sort of use lower levels of energy that have a, that you can prove are having less of an impact on the environment. That drive sort of social awareness and those sorts of things. I think an interesting one is I saw some real innovation around the use of data, for example, and I think that's a really important facet, that it's not always just the tangible, it's actually some of the information that we've got to hand that we can make smarter decisions around, things like repairs and maintenance for our products, as well as our own machinery as part of the production landscape. But I've certainly seen that with some large engineering businesses that produce sort of construction machinery and those sorts of things. They've got a remote data analysis and what have you. They're checking the sort of the state of large bits of kit, and working out when they need to be repaired. And that saves them sending an engineer 200 miles to go and repair it and those sorts of things. So I think there's a lot of innovation which is being driven through, and it's exciting to see. And some of those ideas I think have also come to bear, throughout, the pandemic, for example, because we've had to think differently. But I think it's had a bearing on our mindset around ESG as well.
Absolutely. Could we just move to the next slide, because it actually leads on very nicely as we just highlight some of, moving on again, Baljeet, to the innovation, to the benefit side of it. Sorry, back one. What you've just said, Tim, it actually links in very nicely to a question I asked Fhaheen earlier in terms of the investment that had been set aside in the manufacturing space. Had any of that been tagged specifically for ESG? So I suppose it's one of the things we debated was it's not necessarily ring fenced as such, but very much for that different types of technology, what it may bring in terms of efficiencies. So indirectly really addressing the ESG agenda, which is great. But I think we've picked up quite a few benefits here in terms of some of the key highlights, particularly as you say on the data side, Tim. I think an important one to note here is also on that access to credit, ability to attract investment. As we said before, from an investor community perspective, really important in terms of that clarity of your metrics and having that confidence in being able to report them. And I think a really big one in terms of that overall corporate image and reputation. All stakeholders looking increasingly to what you're doing on that front as a prerequisite, not as a nice to have, but an absolute essential. So in the interest of time, I'm just going to move on to the next one in terms of what you should be doing now, folks. So we've talked quite a lot about the different drivers, the different requirements in terms of ESG, some analogies and what people have been doing. And I think, as I said, you're all at different stages of where you are in that journey, be it purely responsiveness to regulation, that you will do the minimum to get by, versus those that have very evolved annual sustainability reports that bring to life the myriad of things that they do throughout the year. But a simple 4-point plan here to consider. You'll probably recce this and think I'm already well progressed on this, so I'm good, or where do I need to start, which is the question I hear from many at the minute. But the very first point, really importantly, is defining your story. What we quite often hear from people are, what standards should I use? Where should I begin? Which ones do I have to report, not have to report? The most important aspect is for you to sit back and understand who are your stakeholders, what is important to you as a business, on what are the risks and opportunities for you. This ultimately will allow you to drive out what your strategy is, what your value proposition is, equally what it, from a materiality perspective, are the most important aspects within that, and be able to set out clearly what that ambition is. So if you haven't done that, that's your starting point. Then from there, it's very much, we talked about ESG and the specificity within this, building the program, creating the infrastructure around this. What are the policies that underpin that? What is the training, as Tim very rightly said, that is required to get people up to speed with this, and how you set out what the data is, the processes, the people involved to be able to build out how you are actually going to be able to generate the information needed on a consistent basis. That is the really heavy lifting bit at the beginning. And then from there, it is into your program of how you're going to monitor this on an ongoing basis and create the reporting required. An important point to note here as well is the need for assurance programs, be it internal confidence or external confidence. We're seeing it increasingly the norm where independent assurance is gained, because it gives that extra credibility to what you do actually report. And then finally, it's innovation and horizon scanning. This agenda is not static. It is a moving feast. So how are you going to stay abreast of what's happening? What is your innovation hub of really knowing what's out there, what you're going to need to do going forward, and really making sure that you stay relevant and up to speed? So some food for thought for everyone. And in the interest of time, I will now move to Q&A budget, as no doubt Tim will have something to add throughout that as well.
Brilliant. Thank you, everyone. We've had a couple of questions come through. So the first question, Seamus or Fhaheen, if you could help with that question. So someone's just asked if you could share your insights into the outlook for the automotive sector in 2022.
I'm happy to start that off, and if Seamus would like to just jump in at the end, then happy for that. We actually forecast the automotive sector to grow by about 11% this year, and about 14% in 2022. Both of those are actually significantly downgraded from what we were expecting before the issues that the automotive sector were facing in recent months, such as the, I mentioned from our presentation on the shortages of semiconductors, but also it's more than that. It's also just difficulties in accessing steels and rising energy costs. We still expect growth for the automotive sector in 2022, as I highlighted, but that is down to because the demand for vehicles, not just passenger vehicles, but also things like lorries and heavy goods vehicles and that sort of thing, is so high at the moment that any of that output that is produced will automatically or almost immediately be sold somewhere. Long term, thinking further ahead from 2022, I mean, the issues around the semiconductors, I guess, is quite significant for the automotive sector, partly because they, as a global industry, are actually quite a small customer of semiconductors. Semiconductors chips go into pretty much everything that's made in your smartphones, your laptops, your computers, anything like that. In comparison to, let's say, companies like Samsung or Apple, who just announced an iPhone 13, and Samsung is just about to announce a new phone. These tend to be the sort of the first customers, the priority customers for semiconductor chips. So even when the supply issues subside, our expectation is sometime in 2022, it's likely it would still be somewhat even longer for the automotive sector to actually benefit from that improvement in supply chain disruption. And even thinking almost 10, 20 years ahead, many countries are also making huge investments to actually to avoid having this issue ever again. I think the biggest ones seem to be from the East Asian markets, where I think like South Korea and China are also making huge investments into expanding their capacity of semiconductor production and steel production as well. At some point, we may end up with an oversupply of semiconductor chips in order to avoid these issues again. But for the time being, we expect that there's a challenging road to growth for the automotive sector because of those barriers. But there is a lot of demand for vehicles right now. So there is a big opportunity there for those firms that are able to actually respond to that challenge. I hope, Seamus, do you want to add anything to that?
No, Fhaheen, I think that was pretty comprehensive, but just two things that I would add, maybe the two unquantifiables, which is, first of all, with COP26 coming up at the end of the year and the growing green agenda, the impact that that will have on the sector is as yet unknown. But there is likely to be, from a public policy perspective, a greater focus on public transport and things like trains and buses, as opposed to cars, shifting commuters away from individual transport vehicles. And the other big unknown right now is the legacy of working from home. The whole world, it seems, has been working from home or working more flexibly over the last year. And we have yet to see how much that type of behavior will be embedded in the medium term to longer term. It could be the case that, as we have seen, urbanites decamping to more rural areas, that there could be an increased demand for personal transport vehicles. Equally, with less need to commute to the office, we might see the exact opposite. So we're going to have to wait and see a little bit over the coming months and years about the impact on consumer behavior, but just something else worth factoring in.
Thank you both. And just following on from that, Fhaheen, in your presentation, you talked about growth of investment for capital equipment. Do you have any insights into investment in process improvement and digital technologies?
So what we have found, this is more kind of member anecdotally, the investments that have been currently prioritized are in improving processes. So these are around buying new machines to expand capacity. In many cases, it's just to buy the latest versions of old machines that they've been using to make their production output, to increase their output. We have also seen an increase in investment, some of that investment being also down to training as well, because of the labor shortages that have been cited by manufacturers. Actually, some of that in growth in investment intentions is actually partly down to investing in current skill sets for current employees. From the digital point of view, we have seen a significant interest in manufacturers who have been considering new opportunities, let's say like new software packages, increasing the sort of digital connectivity between the kind of the capital side of the production machines and let's say connecting these things to like iPads and that sort of thing. But there have been some barriers that manufacturers have faced specifically, such as the Help to Grow digital scheme, which is intended to allow that kind of transition towards digitalization, but actually does not include many manufacturing specific technologies such as MRP systems, which manufacturers have faced barriers in actually accessing. So this type of scheme affects SMEs a lot more than it does affect larger firms. But I think going forward from a policy perspective, we should also consider whether or not we should be redesigning such policies with manufacturing, at least the way manufacturers are built in mind, because for the time being, it's sort of built for software companies and that sort of thing to benefit them from those schemes a lot more than manufacturers are. So that digital transition is taking place, but it's perhaps not as easy as they would have liked. I hope that answers the question.
Thanks, Fhaheen. So the next question to Fiona and Tim. So the UK is on track to hit its net zero ambition by 2050. Yet we also get asked about targets around being carbon neutral. What do these actually mean?
Very good question. I'll pick that one up, Tim, and then if you have anything to add. The terms are very much used interchangeably, the carbon neutral and indeed the net zero. The carbon neutral side is basically understanding what your emissions are, understanding what your footprint is, and making sure you ultimately balance out what you put in, you take out. Most people tend to take an offsetting approach to that first in the initial stages. But with the net zero side, what the actual encouraging factor there is trying to prompt you to reduce your carbon emissions to the lowest levels possible, be that reduce the use of fossil fuels, move to solar power, move to wind power, alternative energies, so that you're minimizing that output on your side to the lowest levels possible and really only offset as a last resort. So yes, we do have big ambitions. The government is pushing very much on the 2050 deadline. I think by 2035 we'll be about 80% there, but there's a big push in industry, particularly with COP26 coming up, which Seamus highlighted, that we are all getting there quicker because we all need to do more now. So terms that I prefer to use, even not necessarily carbon neutral or race to zero, is about how we become carbon regenerative or carbon negative in how we're actually removing more carbon dioxide from the atmosphere than what it emits, and thus creating that negative balance on a global scale. So I think the rhetoric will continue to change on that. So for now, we should be doing the minimal to at least understand what we are doing and take up measures to try and reduce that as much as possible.
Yeah, I'd echo that as well, and sort of looking at what, there's some fantastic initiatives which have been going on. You're seeing, in the retail sector where, they're getting rid of bags and sort of trying out new approaches, new shopping methods, around, you can go and sort of, use the vats and sort of take your own bags and reusable, take your own jar, those sorts of things. We're seeing a lot more where it is, we're seeing sort of fashion retailers that are, using or reusing materials, and less of a sort of a throwaway culture. And I think a lot of that is coming through some of these initiatives, but I think a lot of it is being driven by, demand from customers. That's what we want. We're expecting, our companies that we're buying from to be, much more, to be reducing their carbon footprint and be much more effective and efficient in how they're delivering things.
Thank you both. I'm conscious of time, but we have had one more question come through. Fhaheen, I don't know if there's anything you can add to this, but do you have an outlook for the rail manufacturing industry at all? It's very specific.
I think actually Seamus added a few good points earlier already on this, with the transition away from individual modes of transportation, leading to an increase in investment perhaps in more communal transportation such as rail, but also others, as well as the work from home, situation, which may also inadvertently reduce the use of trains as well. So there's going to be a rebalancing effect where the drive towards, climate like sustainability and being green is going to increase investment in the rail industry, but also the new way of living and working from home may also reduce that investment in trains, because perhaps people are using them less. So we can perhaps expect further growth. I think there were some new train stations opening in London quite recently, but investments like that also take many years to actually to come to fruition. And perhaps if we were to incentivize an increase in use of transport, one of the current major barriers right now is the actual initial entry costs for consumers, which is quite expensive to use and often results in a preference for individual modes of transportation, such as vehicles. Our current forecast, just for your reference, which rail falls under the category of other transport in the SIC classification in UK, we expect a contraction this year, which is mainly dominated by the aerospace industry, but we do expect some growth in that as the UK people come back to the streets, but also people start going on holidays and business travel and that sort of thing again. So I hope that adds something, but Seamus may also want to add his input there.
Yeah, just one other point to mention, which is the Prime Minister's Levelling Up agenda. There's a consultation due to be launched sometime this autumn, probably late October. And one of the things that many stakeholders, including Make UK, will be pushing for in that review is rail transport links, particularly in the north of England. We know that the southeast and London have a great supply of public transport systems, but there is a paucity in the north, and it affects manufacturing and industry across the board in terms of the ability to commute, for workers to commute between cities and business connectivity and the agglomeration effects that come from that. So I would expect there to be quite a lot of focus on rail transport specifically, but public transport more generally in that review, and that bodes well for the industry, I think, as a whole.